Hi, it's John Mousseau, CEO, Director of Fixed Income at Cumberland Advisors. It is Thursday. The markets are closed tomorrow for Good Friday. Matt and I are doing separate filming this week, and no discussion about it. Another tough week on bonds. 10-year Treasury is now up to essentially a 280. The 30-year Treasury is a 290. But what's interesting is that the 5-year bond is now around a 270 or so, and a 2-year bond is actually came down a little bit this week to a 245. So you've had a lowering in the 2-year yields and higher rates longer end. In other words, the yield curve has become steeper. And this is what we talked about a few weeks ago, that we did not expect to see a very flat yield curve. Why? Because the economy is still chugging along. Yes, we have the inflation. We do think inflation is going to come down. Inflation expectations in the bond market would tell you that it probably retreats at some point to 3-ish. We will see. But we do start to see some signs out there that the economy may be cooling a little bit. But what's interesting about the steeper yield curve, and think about it, from 3-month T-bills out to 2-year notes, is about 200 basis points, 2%. There's plenty of room for the Fed to raise short-term rates on a schedule and not scare the hell out of the economy where you suddenly have a very flat yield curve. On munis, a total giveaway. 4% yields in the long end. We are shifting portfolios and buying longer bonds. And we think it's probably the best opportunity that you've seen in 5 years. You had a brief opportunity in 2020 in the COVID meltdown in March, but it only lasted a couple of weeks. This is going to last a little bit longer until expectations change out there. But the last time we saw this was when President Trump was elected and the market sold off. And we thought that was a great bargain, and it was. And we think buying tax-free bonds at 4, when the taxable equivalent of it is almost 6.4, and our belief that inflation is going to come back from the 8 handle that you see now down to something much more reasonable as we move out over the balance of the year, we think this is a heck of a bargain. So what do? We shift some bonds from the shorter end that have acted defensively. Doesn't mean they don't have some losses in them, and locking in this 4% yield. We hope everybody has a very nice holiday weekend, and we will see you next week.
Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, April 14th, just after the close. Keep in mind, markets closed for Good Friday tomorrow. So, choppy week. You could almost say an ugly week. There were some areas that worked. There's some areas that were up this week versus last week. We'll get to those in a moment. What are some things bothering us? Last Friday, I took a look at the 10-week ratio, showing that maybe the market's trying to bottom, but would still have to get some buying come in. We just didn't see that good bid. Midway through the day on Wednesday, it looked like good demand was coming along. See if we could carry it into Thursday. Futures were heavy this morning and just spurred selling throughout the day. You tend to see that in equity markets that are in a battle. A lot of headwinds. Very difficult to get past these headlines that the market is trying to price in daily with Ukraine and Russia. Difficult situation from not only economic purposes and human life purposes, but trying to handicap supply lines and commodities. Right? You've seen commodity trading run into bouts of illiquidity. Very nerve-wracking as a trader. Where we do have any commodity exposure, it's through the equity side of the commodities. Stocks that are in the commodity business, metals, miners, traded very well this week, are getting a little overbought. So we have to be careful there. That's not a very broad sector. In other words, it's not like the XLK, the technology sector, that has deep company volume and many companies in that basket. Your metals and miners and different commodities baskets are fairly thin, so they can get whippy. We can't get too greedy there. In terms of what else is working, healthcare is working pretty well. I'm going to say, unfortunately, if you're a bull on the broad markets, the defensive sectors are acting well. Consumer staples, utilities. Boy, utilities, you plug in some numbers on utilities, and they're very expensive on a growth ratio, from a growth ratio standpoint, but right now, defense is all anyone cares about, being as conservative as possible, and therefore utilities are pulling money. We need to see some money flow back into some of the growth areas to help the indices out. So, in terms of our portfolio, still barbelled, growth and value, growth hurting, value helping. In our U.S. ETF portfolio, remember we manage multiple portfolios, multiple strategies. In our U.S. ETF portfolio, we did sell financials. Financials had a decent move through the fourth quarter, and even with rates higher, which should benefit financials, insurance companies, banks, these are trading very heavy, really signaling that the economy, from a trader standpoint and an investor standpoint, may be in trouble 6 or 9 months out. So is it a soft landing, or do you get into that dreaded recession word? That's not for us to figure out today. We'll trade it as it comes. But in terms of what's working, I'd much prefer for market growth to see a little bid come into growth. So in terms of what we'll be looking at next week and where are we positioned, we do have cash. US ETF has about 12-13% cash. Be looking for some ideas there. Tactical Trend has 18, 19, 20% cash. Be looking for some ideas there. Our U.S. core portfolio, which focuses on the broad indices, only about 5% cash, but has been helped to a nice degree by a value tilt, 60% value, 40% growth. International, we're fully invested after adding that PIC security, which is the global metals and miners, and then a small slice of China. So in terms of international, we'll keep an eye on anywhere where we can raise money into a rally. Have a great weekend. We'll see you next Friday. Don't forget to like, comment, and subscribe.